Welcome to ForexTV.com. Today's Thursday, March 19th. I'm Tim Kelly with the New York Forex Market Buzz. Gold prices are extending their gains Thursday as the U.S. dollar continues to tumble lower, but off session lows. Gold, along with all commodities, appears to be benefiting from the FOMC decision to implement major quantitative easing measures on Wednesday. The Fed announced that it would expand its balance sheet by almost $1.2 trillion, which includes purchasing $300 billion in longer-term treasuries. U.S. equities are lower, but off their session lows at midday. Now for a look at the latest headlines moving markets today. A measure of the economy's future performance dropped, and the number of Americans collecting unemployment benefits surged to a record. Evidence the recession is deepening as policymakers try to unfreeze credit markets. The Conference Board's index of leading indicators, a gauge of the economy's direction over the next 3 to 6 months, fell 0.4% in February, less than forecast. Manufacturing in the Philly area shrank for the 15th time in 16 months, and according to a Federal Reserve report, and the Labor Department said that 5.47 million Americans are getting jobless benefits. Today we're joined by Mike Englund, Principal Director and Chief Economist at Action Economics. Mike, thanks for joining us again.
My pleasure.
Mike, we've got a situation here, just starting with the Fed's announcement yesterday that they were stepping up their quantitative easing measures. A lot of folks are a bit skeptical about Bernanke's motives here and his plan, actually, not necessarily his motives. But the criticism comes in the form of perhaps saying a little bit crudely a shell game, selling debt through the front door and buying it through the back door. Is that really liquidity, or is this just a revolving door?
Well, I think what's happening in the marketplace is that we have a wide range of problems we're facing simultaneously, and some of them are contradictory. Some investors are focused on some problems, and others are focused on others. The Fed's pretty focused on deflation and the notion that because a short-term rate has gone to zero, that their hands are tied in easing policy, and they're doing whatever they can to try to drive yields down through other means. Their perception is that however many reserves they add to the system, they will be able to pull them out of the system later at the end of this cycle and early in the next expansion and avoid inflation. Other investors, I think, are concerned that often these kinds of reserve explosions are followed with an inflation explosion, and that it's only a matter of time. People perceive inflation to pick up anytime soon. But I think there's a perception that once the Fed expands its balance sheet by this amount, it's really not going to be able to so-called take those reserves back later when the economy starts to recover. It'd be nice if when the economy recovered there was a loud bell, basically an all clear, and everyone agreed we were in a recovery. The problem is that when the economy recovers, there'll be some that think we're still in recession, some will see continued risk. And the real question is, at that point in time, will the Fed really pull these reserves out of the market, or are we going to see the inflation numbers start to creep up?
Well, Mike, the efforts thus far have centered around freeing credit. This obviously is a dramatic step towards doing that. On a macro level, what do you think the time frame would be? When you put this together with some of the other small business credit agreements coming out of the TALF, and to free up credit for small businesses. What's the time frame here? I think that's a major question. Does it take 1 month, 3 months, 1 year, or more?
Well, I don't think anyone knows the answer to that. I think the working assumption in the market is that the economy is probably going to creep back toward positive growth around the middle of the year. Often when you say that, though, you recognize the risks involved. We really don't know that's going to happen, and the monthly economic data recently have sent mixed signals. Last week we were encouraged to see the retail sales numbers looking stronger. It might suggest that the pullback by the consumer may have stalled into January and February, and maybe we're seeing the limit to the damage there. But we got the Empire State and Philly Fed early factory sentiment readings for March, and those numbers suggest that the factory sector actually experienced worse conditions in March than in February. There was some hope there'd be a stalling in that pullback because the auto sector had really pulled back pretty sharply into January and February in terms of assemblies. We thought there really wasn't much lower the factory sector could go from there. But these numbers have continued to remain weak, so certainly the risk is that the market assumption that maybe we're looking at a 3 or 4 month horizon until we start seeing some improvement in credit conditions may be overly optimistic.
Mike, you mentioned retail sales, and I think a couple of weeks back you and I were talking about that on the air. However, right now you're looking at the employment situation. You've got 14 regions in the Fed survey that have 15% unemployment. So that harkens back to that retail sales number, and is that a believable number at the face value of it at the print? If we're seeing some major regions in the country experiencing now 15% unemployment, going back, do we revise our evaluation of retail sales and say, well, this is just an aberration?
Well, it's always hard to know where sales are going to go as we move forward. However, the numbers were strong enough, and even if you were to plug in sizable downward revisions that are in keeping with the kinds of revisions we tend to see with the series, you can't get there from here in the sense that the contraction that we saw through the second half of last year really can't appear to have been extended into the first quarter. Real consumption fell at about a 4% clip in both the third and fourth quarters, and right now with 2 of the 3 months, we have positive growth of about 1% in the first quarter. So like I say, maybe we'll see some downward revisions, but clearly that downdraft, that powerful downdraft we saw in the third and fourth quarters didn't extend. It may resume as we get into the second and third quarters, but I think the real positive for the economy there is that ultimately a consumer panic isn't something that's readily akin to modeling. Economists like to build models and predict where things will go, and many people said, well, this is a wealth effect they've been looking for some time. They're claiming is now appearing in the data, and they're extrapolating the savings rate and saying, well, the savings rate's just going to keep climbing and consumers are just going to keep pulling back. But the wealth model through the 1990s and into the 2000s did an extremely poor job of predicting consumer behavior. Our interpretation of it is that consumers panicked in September and October as news soured, and it's really the cart before the horse to say that wealth declines are driving the consumer into lower spending. We'd argue that the consumer pulled back, and that's probably why stock prices fell and the real estate market continued to fall apart. So that pause in the first quarter, I think, is a good sign. Whether it continues into the second and third quarter, of course, is yet to be seen.
So, Mike, one of the major themes behind the Fed's actions was to try to push down consumer rates for obviously for homeowners. In terms of the long end of the yield curve, what are we looking at in 3 to 6 months right now? Can these these actions sustain the kind of objectives that they were designed?
Well, unfortunately, that's another thing that's just impossible for economists to estimate. If you look at the policy announced on Tuesday from the Fed, a $300 billion purchase of treasuries barely scratches the surface of new treasury issuance this year. So if you're building a model of sovereign debt yields, it'd be hard to argue that longer-term yields will be much lower on the purchase of $300 billion. I think what the market's looking at is the opening of Pandora's box, that essentially the Fed is not just trying to accumulate assets in what they perceive to be distressed markets. Now they're trying to steer the yield curve toward a flatter shape. They're trying to actually drive down longer-term yields. To what degree will they be successful at that? Of course, we can't know. Ultimately, I think many traders don't want to be on the opposite side of the trade from the Fed. Once they heard that announcement Tuesday, everyone went long treasuries. Ultimately, whether the Fed can win that game or finds that it's losing the credibility battle while it's gaining the war on treasuries is unclear. But right now, everyone has pretty much decided to side up with the Fed, and treasury yields are falling. I think 3, 4, 5 months down the road, as you're looking at these sort of market rates, whether the Fed prevails in that, I think, is yet to be seen.
Well, I think the linchpin here, I guess, is remains to be seen is where inflation goes. That could be really the fly in the ointment, I guess.
Well, yeah, and the dollar's been falling, and we now have oil over $50, and I would think there would be some at the Fed concerned that the confidence effect of their policy on the dollar may be having the opposite effect that they intended, even though the boost to the market that came with the announcement yesterday, I suspect, startled the Fed as much as it surprised people in the marketplace. I don't think they really believed they could trim 50 basis points off long-term yields. But again, 2, 3, 4 months down the road, whether the Fed really wants to adhere to this path is going to be unclear. And if the Fed were to reverse course later in 2009 in its strategy to manage the yield curve, But that could have adverse effects because of the expectational impact it would have on Treasury traders. So they've sort of started what could be seen as a bit of a dangerous game. So far, they have succeeded in lowering yields pretty substantially, but it's hard to extrapolate where that's going to go.
Mike, we saw a pretty severe knee-jerk reaction in terms of dollar weakness yesterday in the sell-off. That could be just that, a knee-jerk reaction. So applying some of this macro economics to a shorter-term trading application here, do you think that we could reverse that as this is digested by the marketplace? We've got equity markets turned negative today, off their session lows, but perhaps that'll take a little bit off of the risk appetite at this point, and maybe show dollar strengthening as it looks like it is doing marginally, albeit. Is it a possibility this was just a knee-jerk reaction, or you think there was justification for this kind of move?
It's hard to know where we'll go from here. I think it's easy to make the case that the market overreacted to the statement on Wednesday, and so perhaps going into next week we'll see some consolidation. I think the bigger positive for the dollar is that old expression in the land of the blind, the one-eyed man is king. And you could argue that the dollar should be a weak currency, except for compared to all the others. Gold rallied pretty sharply, and I think perhaps that's a reflection of the sell-off we're seeing in all currencies relative to the gold as a store of wealth. And we may find going forward that as much as the surprise to the market Wednesday was led by the Fed, people may be reevaluating the risks across the G7, and we may find that the plus side for the bet with the dollar is that of all the weakened countries, the U.S. seems to be experiencing the least damage, and perhaps that'll put a positive bid on the dollar going forward.
Well, just to kind of close this up, Mike, we see the CRB index going up. We see commodities are rising. Gold, after a little bit of a pullback, has, as you said, made some very positive advances. Again, this could be knee-jerk reaction, but when we start to see CRB and gold making significant gains, and I hate to keep bringing it back to this, is this not a harbinger of inflation at this point?
Well, it's certainly the risk, and I think there are many in the marketplace who've tossed their hands up who are predisposed to see the risk here as the longer-term risk of inflation rather than the shorter-term risk of the business cycle. And I think this last policy move has added insult to injury. But there are many economists and policymakers that seem convinced that deflation is our primary concern. Of course, it will take time to know who's right in that debate. The marketplace, I guess, will dictate to us what the relative weights are in those views. It's hard to know how to extrapolate that, because as long as we get a panic trade, which I think the last couple of days has been more motivated by the emotional response to the statement late Wednesday and today in today's markets, it may take a while to really sort out how many people are on either side of this trade.
Well, Mike, thanks for your insight. I hope you'll join us again in a couple of weeks' time to assess what we've seen today.
Well, it's been my pleasure, and I look forward to talking to you again.
Okay, thanks again for joining us, Mike. This has been your New York Forex Market Buzz with Mike Englund of Action Economics. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on forextv.com.